Welcome to Thursday Night Stock Charts Live, and Tesla is in trouble. We're going to talk about that this evening and the reasons of as to why and what the charts look like moving forward, both on a ratio basis, meaning relative to the S&P 500 and Tesla to itself on a short-term view and a longer-term view. A lot to go over tonight in terms of economic data, geopolitical risk on the table. A lot is happening here, and we'll touch upon the ever-growing incompetence, the naked incompetence that we have running this country. But as always, what we want to do is that we want to be neighborly. We want to say hello to people, acknowledge that they've joined us, even though I'm late, as usual. And let's just say hello, Mr. Pete. Welcome, pal. Hey, you left a comment on the Boeing video, and I went in to reply to it, but they wouldn't let me reply to it. In fact, the comment's gone now. So I'm not sure why. I didn't not want to acknowledge your comment. It was just gone. So not sure as to why that is, but I wanted to get that out there. Jody, hello. Sean, Mr. Sean, welcome. Franklin, welcome. Okay, so a lot is going on in this market, and we are at a tipping point. So there are a couple of things I look at on a consistent basis when news comes out. I look at the yield curve. I look at the expectations of Federal Reserve rate cuts. They're expecting an easing in March. Did the hotter than expected CPI data today, did that derail that expectation, or did the markets shrug it off? And apparently they shrugged it off. And we're going to go over the expectations moving forward, because despite the hot number today, you'll be surprised at what the March number now looks like going into this, what appears to be a Fed easing cycle. So let's quickly go over economic data. We could just skip to Thursday today. Jobless claims came in weaker. Believe it or not, that's bad news. That's bad news for the equity markets. Why? Rising wages. CPI at the headline came in hotter, at the core as expected, year over year, hotter than last year. At the core, also hotter than expected. Remember these numbers, okay? The Federal Reserve is claiming victory for killing inflation, okay? Tomorrow, we are going to get PPI. That's the producer price inflation. That's inflation at the producer level. Is it rising? My guess is yes, and they're passing along to the consumer. So tomorrow morning is going to be an important day, an important announcement, because if this comes in measurably hotter than what we saw on CPI today, well, then that means that the producers are not passing along enough of the expenditures to the consumer. Therefore, their profits are getting eaten away. So that's the way to look at this moving forward into tomorrow. Looking at I don't want to go over this right now. Let's cross this down here. Okay. Looking at the valuation of the market, we're above 32 on the PE ratio. Citigroup came out today disappointed. Stocks on a rearview mirror basis are very expensive. And when you take a look at expectations moving forward, the expectations for Q4 have been ratcheted far lower. As usual, there have been sharp reductions in Q4 estimates to make sure the bar has been lowered significantly for a high beat rate. Exactly right. What they're going to do is they need to get people excited. They need to get upgrades out there. They need to get this next leg of this market moving up higher into March. Why? Because into March, if they're cutting rates, that means something happened. Therefore, they're probably going to be selling stocks. Wall Street needs liquidity to unload those stocks that they own. They need a lot of it. It's going to take months to get net negative or net neutral and or net short. So they can't just go selling here. There's not enough volume. They need more liquidity. Therefore, they need to get you excited. Rah, 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 rah. They need to see that earnings, companies are beating on earnings. And that way the uh, brokerage firms can come out and increase their guidance and expectations, upgrades, upgrades, upgrades. It creates a new news cycle every day you wake up. Wow, look at this, a new upgrade. We must be doing great. Okay, but all the while, in reality, in a rear view mirror basis, this doesn't change. If anything, it gets worse. Stocks are very, very expensive. Now, understanding that what we're in is basically the unwinding of the long trade by the banks. And it's going to last, it's going to take a couple of months. Could end tomorrow for all I know. I'm not that bright. Okay. But in all probability, they are going to, especially given the price action today in equities, they are going to drive equities up higher longer term. Might we correct tomorrow on PPI? Sure. Might we correct tomorrow on the banks? Sure. But longer term, they'll probably get a pullback, you get sector rotation, and money will move into a different area of the market, dragging up the S&P 500. The Qs are still behaving well. Certain elements of the Qs are picking up the slack for the Teslas of the world. Palo Alto Networks, CrowdStrike, all doing very, very well. Very, very overbought, but doing very, very well. So looking at the reasons of as to why the Federal Reserve is going to have to cut rates and address whatever event, and we need to keep this in mind, over the past, I don't know, when was 24 years, let's say 24 years. In March, it'll be 24 years. So that's when we had the dot-com bubble, March of 2000. I know exactly where I was, specifically where I was and what I was doing on that day. You need an event. Back then, the Federal Reserve raised rates too much. Stocks are very expensive, way more expensive than what they are right now. And equities finally collapsed. So you had your event. Then you had 2001, September 11th. Then you had the banking crisis. Then you had 2018, the taper tantrum. Then you had 2020. It's all the same nonsense over and over again, just a different catalyst that sends everything down lower. So if 1987, our trade deficit, back then people cared about trade deficits. Now people don't care. So what we have aligning here is the buildup of poor policies and a government that is just driven by ineptitude, absolute and utter ineptitude. And I'm going to go to examples as I always do. Every single week, I give you a clear, crisp, concise example of how inept and incompetent our politicians are. The only thing they're very good at doing is grifting. They can grift like no other. But those days appear to be coming to an end. I'm more confident now than I have been in quite some time. So permanent job losses have accelerated from the lows of, let's call it 2022. Now they are above trend and climbing up higher. So this is not an event that you really want to see. We still have, as I mentioned earlier, initial jobless claims still weak, but they are still grinding up higher. Looking at the Fed Watch tool, now we had CPI, which came in hotter than expected today. And yesterday, this number was at 68 probability of an ease in March. That dropped down initially on the hot CPI number, then rebounded and actually went back up into the 70s, nearly 76 now, probability of an ease going into the March session. So as I see this, I see that equities are expensive, they're extended. I see that inflation is hot, but the economy is still grinding there. So the word that sticks in my mind constantly is stagflation, stagnant growth, high inflation. So I started looking at the gold mining stocks today, and just off the bottoms, I saw the dollar begin to weaken up because the dollar shot up higher because the bet with the dollar was that, oh, inflation's hot, the Federal Reserve is not going to be able to ease in March. That's not what the Fed watch tool said. It still said, even though it pulled back, it still said Fed's going to go. They're going in March. Dollar moved up, then it moved down, still closed up on the day, but closed off the highs of the day. So during that time with the spike up in the dollar, you take a look at the gold mining stocks, and the gold mining stocks are getting hammered. And I says to myself, why not buy? Why not buy? You got Nugget down in the 20s again. Start doing some shopping. You got to step into the breach sometimes and take advantage of these opportunities. And what happened? Dollar continued lower, still closed up. Nugget closed back above 30. So a good day today. Now, looking at the Federal Reserve's balance sheet, this is a build. We have begun to build on the Fed's balance sheet. So this is like the beginning, I think, of the, let's pretend we're on a plane. All right, we're coming in for a landing in the Federal Reserve's airport of easing. And the first thing that needs to get done is that the Federal Reserve is going to have to stop rolling off debt off of their balance sheet. Why? Because at some point in time, even though we had a good 30-year bond auction today from international buyers, at some point in time, people are just going to say, these Americans are crazy. And it's going to be the Federal Reserve that's going to need to step in and start buying up these bonds. So what was a Federal Reserve that has been taking the Fed balance sheet off of its 2022 highs, that's going to get reversed. And whenever we get the event that's going to cause this next round of rate cuts, well, you're going to see this balance sheet rip through the 2022 highs like a hot knife through butter. Why? It's because you have a law of diminishing return. Every time the Federal Reserve goes to blow out its balance sheet, cut rates, it takes more and more money to get the same amount of reaction out of the equity market to get this big, fat, inflated equity market moving up higher. So they're going to have to take this up to, I don't know, 20 trillion, probably. So expect a doubling of the Federal Reserve's balance sheet in the next 5 years, probably. I hope not. But if they don't do it, in all probability, the country will be in austerity, and our politicians are so corrupt, they're never going to let that happen. And this is not Democrat. This is not Republican. This is an all-in bucket. Criminality, the likes of which have never been seen. So, moving on with more good news, the Federal Reserve's balance sheet expands by most since SVB, Silicon Valley Bank, as banks arbitrage bailout fund. This bailout fund is set to expire, from what I understand, and whether or not they renew it, not quite sure. I don't know if that requires an act of Congress. I tend to doubt that, but this is set to expire. So this could be a reason as to why the Federal Reserve is going to need to cut rates, because these regional banks and even the money center banks, look at Citigroup's earnings today. They're going to have to loosen up the reins on these banks. And this is the opportunities for these banks to better restructure their loan portfolio. If they don't do it, well, they'll probably get bailed out. But I want to say shame on them. So we have a lot going on out there. We have Iran. I've warned about this. I said the Red Sea is one thing. They can play around in the Red Sea, they'll get away with it. But once you start messing with the Straits of Hormuz, watch out. And right outside the Straits of Hormuz, which is right here, this narrow band between the UAE and Iran, is the Gulf of Oman. Here's the Persian Gulf, Straits of Hormuz, Gulf of Oman. They hijacked, here's the headline, Iran hijacks oil tanker off of Gulf of Oman. So now they're messing with the choke point for oil going over to Asia, going over to Europe, not so much here in the United States anymore. We're the largest producer of oil in the world. So with all the events that are unfolding over in the Red Sea, what you're seeing is more militaristic acts going on. I'll go to that article in a moment. But the drama that's unfolding here is that you have shipping rates which are ripping up higher. And what is that? That's inflation. This chart here is the very definition of inflation, whether it be at the PPI level or at the CPI level, it is inflation. So this hasn't hit the numbers yet for next month's CPI and PPI reports. This is just some goodies yet to come. So not factored in whatsoever yet are these hikes. Add to that, we have, where's my other article here? We began to attack the Houthis over in Yemen. So we have China threatening Taiwan. We have the Middle East, Israel, Hamas, Hezbollah. We have Red Sea. Now we have the Persian Gulf, Gulf of Oman, Straits of Hormuz. Lord knows where else we're at war. We don't even know about it yet. Syria. And what do we have? What do we have going on in the Pentagon? We have a Secretary of Defense that was absent, leave of absence, AWOL, if you will, for a week. And what did he have running his department at the Pentagon? A deputy. Where was he? On vacation. He was running the Pentagon on his cell phone and laptop from a beach somewhere. This is the incompetence. This is the mental gymnastics that this government is trying to pull on us. You can't make this stuff up. Add to that, and this is why I'm getting more and more optimistic that people are waking up and saying, man, these are the people that are supposed to solve our woes. The UN, the WHO, they want $150 trillion, half of the globe's wealth. They want half of that for global warming, which they, sorry. It's not global warming anymore. It's not global cooling anymore. It's climate change. They're going to change. They can't even set their watches correctly, yet they want to do climate change. $150 trillion for a thing that doesn't exist. Ask them for evidence. It's hand-picked, cherry-picked evidence, but they can't prove it. They can't back up their argument. All they need to do is call you. You are a right-winger. You are the racist. They'll name call the death out of you, but they will not be able to defend for one moment their position, yet they want to tax you to death. This is the World Economic Forum, WHO, United Nations. Less than 1% of the population of the globe is trying to run it. And they've been doing it for a while now. But that appears to be coming to an end. So you had the Netherlands. I'm not even sure if that's resolved yet. Poland. They just hired a left-wing government over there. Poland has been steadfastly conservative. And immediately, what do? They arrested the former prime minister and somebody else. So the Poles who have seen this show before, They were under the Iron Curtain in the Warsaw Pact back during the Cold War. They know what it's like. They're fresh out of it. It's not that long ago for them. So they've been down this road before. They know what's coming and they want no part of it. So they're taking to the streets in the hundreds of thousands, soon to be millions. And it appears as though the government's already begun to buckle. I can't imagine this is going to be enough, though. Here's the response from the new Polish president. Poland's president says he has started the process to once again pardon 2 politicians who were arrested earlier this week. Why'd you arrest them? Because they were speaking? Now you're going to pardon them? Because you want to stay in power? Because the World Economic Forum likes you? You got to go. You got to go. The World Economic Forum must be labeled, along with the WHO, a terrorist organization. Immediately. They must be labeled a terrorist organization and their members hunted down. Prosecuted for war crimes against humanity. Germany. German farmers. Not even the farmers anymore. Now the truckers have joined in. They've shut down Germany. They're doing it in the railroad stations now, shutting down trains as well. German farmers block roads with tractors and stage protests against a plan to scrap diesel. This is just a new round of attacks, just like in the Netherlands, trying to take the farms from the farmers so you can have Monsanto, Cargill, all these big corporate farmers moving in there and take up all the land. That's who's getting the contracts over in the Ukraine now. Over 30% of the contracts in the Ukraine have already been awarded to who? Cargill, Monsanto, the big names out there to rebuild and farm the Ukraine. So I view this as all good news. This is all good news. Hopefully we survive this monstrosity. But I believe that it's all good news that people are waking up and saying, hey, we're done here. You put us through this COVID shenanigans, these vaccine shenanigans. You put us through all this. And I know I'm going to lose subscribers. I'm losing subscribers today. Guaranteed. I'm going to go after this show. I'm going to look tomorrow morning. I'm going to be down subscribers. So if you're not a subscriber, you halfway agree with what I'm speaking about, please like, subscribe. You know the deal. Okay, so moving on to the CPI data today. So it's important because we have a strategy, right? We want to execute on that strategy, but execute appropriately. So I love shorting stocks. I just love it. I don't care whether I'm long or whether I'm short. I'm not one of these guys that really cares either way. I'll sleep well either way as long as I call my positions right. Maybe because I write right-handed, I throw left-handed, ambidextrous. I don't know. But I just don't have that problem. I never have. So I'm looking for the opportunity to get short the market, but now is not the time. Now is not the time. I put on shorts today of an individual name, but not of the overall market. So today, overall U.S. CPI came out 3.4%. U.S. core CPI ex food and energy moved down to 3.9%, the lowest core inflation reading since 2021. That's why the street rallied. Okay, that's what they're looking at. They're looking for the needle in the haystack, that little glimmer of hope that's out there. Add to that the fact that what happened? Expectations for a rate ease grew. Go figure. How does that happen? Okay. So what is causing the inflation to be so sticky? Owner's equivalent rent. That's a biggie. Owner's equivalent rent. So that's how the government defines what's the cost of housing. And it's really not an appropriate way of measuring it. They're going to go to landlords and say, what are you charging now for rent? If they did that, then they'd have to report a real number of what housing costs, and they don't want to do that. Because remember, every time CPI goes up, so does the Social Security COLA payments. cost of living increases. They don't want to do that. So what they'll do is they'll lie about the inflation numbers. That's what our government's really, really good at, grifting. So this is one of the main factors, along with, this is over the past 3 years. We'll begin down here. Energy, home prices, transportation up 30.7%. Utilities up nearly 30%. Electricity down about 26%. CPI used cars up 24.2%, yet they're declining. We're going to talk about that more in a moment. Food, eating away from home and at home, about the same. New cars up nearly 20%. Wages, this is what the government hates. The Federal Reserve in particular hates this number. They hate the fact that you're making more money. They don't want to see that. That's a problem. They don't mind inflation running up. What they do mind is you being able to keep pace with it. That they don't want. Not that this is keeping pace with inflation. Look at this. Wages are up 14.5%. But in the aggregate, on average, all of this is, you got to be up in the mid-20s minimum. Speaking of used car prices, the current drawdown for Manheim Used Car Vehicle Index has now reached nearly a 21% drop. So this matters. This matters. And I'll tell you why. We started earlier with the banks and that lending facility that they were given by the Federal Reserve. That is coming to an end unless they renew it. And I don't see why they wouldn't. Maybe they can't. I don't know. But the banks since March, that was the last big spike back here in the Federal Reserve's balance sheet, right back here in March of 23. I was in West Palm Beach at the time. I remember it. And the banks started rolling over, banks blowing up. So how does this relate to the banks? What does this have to do with the banks? Okay, good question. The reason why it has something to do with the banks, which are bankrupt. 48-month borrowing rate for new cars has climbed to the highest since May of 2001. So bank repossessions are on the rise. Even though yields have come down, the lending on a used car loan has gone up. Why? Because the risk of default is so high. These banks want to get paid really quick their interest on that debt, just in case they have to repossess it. Credit card charge-offs. Credit card charge-offs hit the highest level since the great financial crisis. Housing defaults are now at the highest level in a decade. This is multifamily housing now. So these are apartment buildings, multifamily units, and again, the greatest level of default since the financial crisis. So you see where I'm going here is that you have the sticky factor of permanent job losses on the rise. Why? AI. Companies are being very vocal about, we're not hiring back. We're Amazon buying robots to do the labor of a human. And these are pretty agile robots. I took a look at them. So they're laying off people. AI is here. It's hitting the workforce. More good news. And I have a dozen of these. I'll only go over one because it's the most recent. Imagine buying real estate and seeing the value plunge 70% in just 3 years. So this unit in Fairfax, Virginia, this is high value property, Fairfax, Virginia, sold for $9.5 million. In 2020, it was acquired for $31 million. Think about that. Not only did the guy take a loss on the purchase price, but he also invested millions in renovations. I got to subscribe to this. Oh, I'm already subscribed. So this is not just one instance. I don't want to bore you. Every day I see these. They come more and more every single day. So this is for real. The one bit of good news that I saw today, and I want to share it. I don't always want to be doom and gloom here. But where employed U.S. adults say they work primarily, look at the trend here. The trend at working at the office is up 33%. Who'd have thunk it? I haven't heard of anybody going back to the office full time, and I haven't heard of anybody having to work more at the office. But apparently, there appears to be a trend to back to office. I know the big banks have been like that for a couple of years now. J.P. Morgan Chase was one of the first. Morgan Stanley, all those guys say, "Hey, you want to be a trader here? You come back to the office. Wear a suit." Credit card interest rate payments. Back to the consumer, all-time record highs. The consumer's tapped up. What are they using right now? They're using buy now, pay later. That's the next big bubble. I've already done a video on it. I've talked about it on a live stream. You're probably not going to see a huge expansion in credit card debt anymore because the consumer's tapped out. What the banks are going to do now is they're going to drive up interest costs, forcing those people to default. And I don't see a lot of hope out there for the banks whatsoever at this point in time, with the exception of the fact that they're going to be able to restructure their bond portfolios when the Federal Reserve eases, but they're going to have to ease quite a bit. It's not going to be one rate cut and the banks are out of the woods. They're going to have to do multiple rate cuts. All right, so yield curve. This is the 10-year versus a 3-month. I think I went over this the other day. And for that matter, let me bring up my chart. This is my personal chart. So you can see that whenever, and if you've been watching this live stream for any length of time, you'll know that the problem with an inverted yield curve, meaning if you're new and you need a quick explanation, an inverted yield curve is when shorter term maturities, in this case, a 3-month T-bill, is yielding more than a 10-year Treasury bond. Think about that. So you're getting paid more to borrow or lend to the government short term than you are to lend them 10 years. Why would you buy a 10-year bond when you could buy a 3-month bond and make more? Doesn't make sense because there's something wrong. It's silly season. So what you're seeing now is the steepening of this yield curve. And this is a great chart. This is what I always try to articulate. And maybe I ought to put on these little balloons here. 1990s recession, we know about that. That was the savings and loans crisis. This is when I got into trading. Dot-com bust. This is my first drawdown, big drawdown there. Made a lot of money here, lost a lot of money here. Then I learned a lot of lessons. Great financial crisis. Actually, this is the top here. This is March of 2000. Great financial crisis, 2020. And here we are today. Steepening. Yet again. So there are a few charts that I use to identify when it's time to get net short the market. The first is I use the major indexes and I look and see where they're at technically. What's the volume? Typical technical analysis. Are we seeing bearish divergences? I'm not talking on a daily chart. I'm talking on weekly and monthly charts. And we look at that higher level view. Okay, we want to get a feel for what happens next. Are we in a healthy bull market or is this a sketchy bull market? It's not for real. It's like on a thin ice. And case in point, you have a rising stock market, yet volume is going like this, stocks are going like this, RSI and your stochastics are putting in lower highs with stocks moving higher. Why is that a problem? Well, RSI and the stochastics are forward-looking indicators. They are telling you how the health of momentum is. Is it strong momentum? Is it weak momentum? So if you have a stock market making new all-time highs on light volume and momentum is going in the wrong direction, that's no bueno. That's not going to end well. So all I'm going to be looking at is, okay, I'll wait till we hit the upper band of resistance. I'll start nibbling to the short side. Once we break, I'm all in to the short side. We're not there yet. We're not there yet. And there's a lot of chatter in our Slack forum about getting short. A lot of my members, they want to get short the market, as I do, but now is not the time. Not yet. So let's stick with this yield curve right now. And this is one of our tools. I use the 10-year versus the 2-year. Whoever posted this, they use the 3-month versus the 10-year. You say tomato, I say tomato. What difference does it make? Whatever works for you. So looking at my yield curves, things get a little bit wonky here, okay? Because we have broken out on a weekly time frame and we are moving up higher. Remember, when you get the steepening of the yield curve, equities begin to roll over. The fact that we're steepening right now and putting in, let's go to a monthly chart, putting in a monthly breakout early in the month, still half a month to go, a little bit more than that, but we're breaking out at a monthly time frame. This should not make anybody feel good. If you're not watching this and you're net long this market, you're not doing yourself justice. 14-day free trial offer. Join us. I go over these charts all week long. Even on the weekend, I'm working for you. So sign up, 14-day free trial offer. Know when it's time to get short this market. Now is not the time. Individual stocks, yes. So what else I'm going to be looking at? 23 watching, 3 likes. Folks, if you could please do me a favor, I guarantee you, I am, because I speak my mind here. People don't like it. They want me to be bullish. I'm not going to be I'm not going to carry water for the government. I'm not going to carry water for Wall Street. I say it the way it is. So please help support the channel and like, subscribe, leave a comment, please. Even if you watch us on the replay, because a lot of people watch us on the replay, a lot, far more than what are on right now. So like, subscribe, please. It really helps me out. So looking at the yield curve in a different way, and this is what I like to do, is, where is it? What did I do? I overwrote it? I think I overwrote it. No, I pulled up the wrong one. Hold on. Yeah, you know what? I don't need to go too crazy here. Let's just do this. Okay. So what we're going to do here is we're going to run a ratio chart. And what I want to know is what's outperforming what? What's outperforming what? Is the yield curve outperforming, or the steepening yield curve beginning to outperform the S&P 500? I find that interesting. And look at this. The price performance of the yield curve. This is on a monthly chart, folks. This is not a 5-minute chart. This is not a 20-minute chart. This is not an hourly chart. It's not a daily chart. It's not a weekly chart. This is a monthly chart. This is no joke. This is like macro stuff. So what you're seeing here is the Pimp Mac Daddy of higher lows. And what I also want to point out is this. Double bottom. We've already broken out above the pivot point, and what you have here is a launching pad for the yield curve. And this is relative to the S&P 500. So the yield curve steepening is at current technically stronger than the S&P 500. Think about it. And we've been here before. Here's 2020, and it began before COVID hit. COVID hit right here in early 2020, but the steepening began before then. The relative performance of the yield curve began months before. This steepening began back here in 2023, the summer of 2023. We're not even halfway through the month of January. I'm talking like about 2023 as being 5 years ago. So this is a problem, and I'll illustrate to you why it's a problem. Overlaid in blue, let me upload this. Overlaid in blue is the S&P 500. Let's play a game. Indulge me for a moment. Don't try this trick at home. So here is, let's go back. How far can we go back here? Let's go back 25 years. That'll get us since the dot-com bubble. Now remember, this is a ratio chart. This is not just the yield curve. This is the yield curve versus the S&P 500, okay? Ratio chart. Steepening, S&P 500 rolls over. That's a dot-com bubble. Fast forward, I'm sorry, this is the dot-com bubble. Back here, my apologies. This is the financial crisis. This is COVID. Look at the price action here when you get the steepening of the yield curve. And let's take a look at this on a weekly time frame because I'm curious as heck. Let's just bring this back to present day, clean this up a little bit. So weekly chart, again, we need to, what I like to do when I look at these charts is memorialize them. Say, okay, let's reference this for future so that when you look at this chart again, you could either say you were wrong on your last call or you were right on your last call. Your observations are on point. I'm happy to say that even at my very, very early stage of midlife, I am still spot on quite often. Every once in a while I get it wrong. So here we go. Bang. Breakout. Now this is a problem. This is a higher low. One trading day left to go. And I can only understate how important this chart is for us when we're anticipating, when we say no mas being long of equities, now it's time to short or go to cash and bonds. So some may be thinking, I don't know what this guy's talking about. Why does it matter? Folks, it's what I get paid for. It matters quite a bit. Here's the yield curve daily chart. It really ripped today quite a bit. Flat relative to the S&P 500, but it's moving up pretty rapidly now. Let's take a look at this on a quarterly chart. I promise I'll leave it off here. Quarterly chart, not that bad yet. Not that bad yet. Not as bad as 2007, 2008. But look at how quickly it took off back in 2000. So if this thing if it gets out of control, it's going to unravel really, really quick. So just be aware that this is out there and it's not going the direction that bulls would like it to. Moving on. Let's talk a little bit about Tesla. I'm an Elon Musk fan, by and large. I love the fact that he's a free speech guy. I love the fact that he told Bob Iger over at Disney to go F himself. He's a baller. Unfortunately, though, I think that Tesla's got a lot of problems right now. And I started getting very, very skeptical about the EV market quite a while ago. And that's because of China, they were subsidizing electric vehicles. Those subsidies went away. And a lot of companies that produce these EV vehicles, they started up new businesses, rideshare businesses, scooter businesses, electric scooter businesses. They all went belly up. Nobody wanted them. And they have thousands upon thousands of electric vehicles sitting in a field somewhere in China, rotting. Fast forward in recent days, the Chinese are now dumping EV vehicles into Europe, driving down prices. Fast forward to today, Hertz, probably the biggest rental car company, at least in America, North America. Hertz begins dumping 20,000 EVs in a shift back to petrol cars. The globalists are not liking this one. Bravo, Hertz. But again, I feel bad for Elon Musk. According to Bloomberg, Hertz began dumping 20,000 EVs on the used car market last month and will be a seller through 2024. How does this impact Hertz? How does this impact Tesla? Doesn't it impact all EVs? Yeah, to a certain extent, but more so Tesla, and I'll continue on and give you the why. The company expects to reinvest a portion of its proceeds from the sale of EVs into the purchase of internal combustion engine vehicles to meet customer demand. The company expects this action to balance out a better supply against demand of EVs. Here's the problem. As of October, shares said EVs were about 11% of Hertz's total fleet, with Tesla accounting for 80% of that fleet. So Hertz is going to dump 20,000 used Teslas, not 20,000, 16,000 Teslas onto the market. And here you have the ads. 2020, this is good across the board. Model 3. I thought I saw Model Ys on there. I guess not. And here is, again, the Manheim. Are these EVs? They don't specify. But the used car market, again, is in a downtrend. This is not going to help. Add to that Tesla used car price trends, 30 days. 30 days. Model S down 7.4%. Model X down 5.7%. Model Y down 3.8%. In a month, a rolling month. So why is this happening? Tesla did it to themselves. They cut prices on the new vehicles. What happened to the resale value of used vehicles? Well, they went down. Why am I going to pay for a used battery when I get to get a new battery for a couple of thousand more? Doesn't make sense. I get a better warranty. So to the technicals of Tesla today alone was down over 2.33%. When they do pull back to a weekly view on Tesla. Where's my weekly view? We are down 4.3%, with the S&P 500 up 1.8%. Not only that, we broke support this week, one trading day left to go. Volume is light, though. To be fair, volume has been light. Now, when you take a look at Tesla versus the S&P 500, the relative underperformance can't be overstated. It just can't be. This is a train wreck. This is an absolute train wreck for Tesla. Weekly view. Lower highs on momentum, RSI, Stokes, and we are breaking down. Tesla is breaking down. Looking at a monthly view, one could argue that we are in a trading range, again, relative to the S&P 500. I won't argue that. We are building momentum on a monthly view, still positive. However, RSI has given up and has begun to roll over. So that puts into question the health of the ability of Tesla. Here's your lower high and your breakdown. The ability of Tesla to maintain this momentum. And I think there's a very good chance that we break. The only thing that could save Tesla right now is if the S&P 500 breaks also and Tesla goes down less than the S&P 500. So Tesla's in a lot of trouble here, folks. I would not be a buyer of Tesla. I wouldn't short it yet. That was a topic of conversation with members. I wouldn't be a shorter yet, but I would entertain after earnings, putting on a short trade on Tesla. We have about 5 minutes left. I got to go to the members area, see if there are any requests. For Wendy. Wendy's putting me to work here. Okay. AAL. Intraday charts look really, really good here. Really, really good. But let's go to single view. Folks, we're going to be using TrendSpider, 35% discount code below. I'm loving the intraday setup here. Good close. Very, very good close on the airlines, or AAL anyway. Let's go to a monthly view to get a feel for where it's been. AAL looking very good here on a monthly time frame. Few resistance levels above, but we're above the VWAP. That's bullish. Weekly view. We are right at resistance. We're slightly above it, actually, but we're right there. You want to see a close above, let's call it 1460 per share. Daily view. We look like we're getting ready to break out here. I'm very positive on AAL. It's looking very good. So bullish on AAL. Volume is good. I happen to like it. CCL. This is actually an IBD darling. Oh, is it CCL or is it the other cruise line? I forget. Don't quote me on that. It may not be CCL. As a matter of fact, now that I put that tease out there, let me validate. All right, CCL. Looking really good here. We're down on the month, but we're off the lows, and I love the higher low. I love the consolidation. Is CCL optionable? I believe it is. Yes, it is. What's the IV rank here? Options are very, very cheap. Very, very cheap. All right, so we're looking at IBD. Oh, yeah, it is on here. So Carnival Cruise Lines I've been shocked that they're on here. Carnival Cruise Lines is on the IBD top 50 stock list. Sales growth rising 41%. Their earnings are not great, but their relative strength is very strong, and it's under accumulation. So Carnival Cruise Lines, a fundamental basis, not great, but on a technical basis, is looking really good. So it appears as though the street is forecasting better days ahead for the cruise line business. Weekly view, one trading day left to go. We broke out last week. This week, we're doing a retest. I think that this is a buy. I like this. I may buy some for myself. Carnival Cruise Line is looking good. Down today, but I still think it looks good on a macro basis, that weekly, monthly view. What else do we have here? AGQ, silver. So silver we own. We own silver. I want to buy more. I did not today. We remain pretty weak on a weekly time frame, but silver is about as cheap as it's going to get. So we're at the lower band of support. I would be an accumulator here. I would nibble, dollar cost average in. I would not go in with both feet. And then as you begin to see strength and you begin to break out, then you want to go adding more. I would be very cautious right now. A breakout above, let's call it 28.30 per share. That would have me buying silver hand over fist. Right now, I would just be nibbling on it. Dollar cost average in. This is a leveraged ETF. So just be forewarned, more volatility. If you don't want the volatility, simply buy the SLV. And that's it for tonight, folks. Donnie, let me refresh. Oh, okay, cool. Donnie, SATS, EchoStar. Let's do a top-down view. I like it. I mean, we had a strong rally, a nasty pullback, and this week we've pretty much negated that horrible price action from last week. And look at the volume. This is not mom and pop buying 100 shares of SATS. This is institutional accumulation. Daily view. A close above 1690, 1685, I would be a buyer of EchoStar. I would have zero problem with selling puts here if it's optionable. I like the chart. I think it's going up higher, a lot higher. INFN. This is a weekly view. On a weekly time frame, we have a breakout. Watch for a retest next week. Make sure it holds. I love the higher low. You have resistance right here at $5.06 to close that mark. I would add more to the position. So what I would do here is I would wait till next week, buy this pullback or this retest at around 460 per share, give or take a penny, then add more on a close above 506 per share. This looks like it wants to go higher. Daily view. You have resistance on a daily time frame. Folks, this is what TrendSpider is so great for. Know where your areas of resistance are. So you have fractal trend lines here. You also have resistance levels here. Click of a button. Those are the drawings. Here are your trend lines. Here are your fractals. All of this is done by AI. So this is probably what's going to cause, Donnie, that pullback and a retest back down to support here next week, because traders are OCD like me. They want to be able to touch, make sure what was resistance is now support. AVTR. I don't know this company. Let me go to a monthly chart. So the monthly chart is interesting in that you have a couple of very, very critical resistance levels to overcome. One, $23.27. Two, $25.33. So doesn't mean you can't buy it, but you want to leg in. You want to put on a few shares right now, scratch the itch, get that impulsivity out of the way. Fine, go for it. Make it a small opening position. Add more on a close above 23.27. Add more on a close above 25.33. Build that position. Yes, you're paying more, but the probabilities of you being right on that trade are more. You're paying a premium for a reason. The stock is behaving well. So reward yourself by buying more because it's probably going up a lot higher. Weekly view. Potential breakout. One trading day left to go on the week on AVTR. Daily view. It's not a screaming buy. I don't think it needs to be. You want to put in a couple of shares? Fine. But focus on the weekly charts and the monthly charts, those resistance levels. Focus on those, and those are your obstacles. Don't worry about what it does day to day. Those are your obstacles to overcome. Nibble now, add more aggressively later when the stock proves itself worthy of your investment dollar. And again, yes, you'll pay a premium. You can get it now cheaper, but is it going to hold these support levels? It's way too early in its rally here. It's only begun to rally since November. It's really nascent rally. So reward yourself when the share price overcomes certain obstacles. Jody, have a great night. Thank you for being here. You're welcome, Don. Anytime, pal. Talk to you tomorrow. I'm not too happy with SoFi, pal. SoFi, I was buying my crypto through. I went in to go buy some Ethereum last night, and I was told that they no longer do crypto. So I had to bail on my Bitcoin today. Because the state of New York won't allow them to allow me to transfer it out of SoFi and into another brokerage. So I had to cash out, pay the taxes on it, and got to transfer it over to another brokerage fund. I'm not too happy with SoFi at all. So they're out of the crypto business. You know, you want to take a quick look at the stock price really quick here. I'm not loving it. This is a daily chart. That's not fair. Let's take a look at a monthly chart. I'm not loving it. $10. They just took themselves out of one of the most profitable areas of the business. Why would you do that? Why would they do that? They're going to stay in the most competitive brokerage business for equities that there is. They're going to stay in the debt business of which everybody's tapped out. I don't understand it. I think they screwed themselves. So I'm not happy with SoFi. I'm done with them. Close my account. Done with them. I would avoid them. Bad decision. I'm sure they have their reasons, but bad decision. Sunday we can let's look at. Sure, are they selling them now? Did they go public today? I don't know, Michael. I don't know. I have no idea. I didn't ask. They didn't ask my opinion. They didn't give me any options. They referred me over to their chosen crypto exchange, and They won't do business because I live in the People's Republic of New York. Folks, everybody have a great night. Have a profitable trading day and an awesome Martin Luther King holiday. Have a great weekend. Be well.